by level 4, where it's very likely that your portfolio will generate more income than you will. And that's where you start to get into a very different conversation. By the end of level 3, by the time you have almost $1 million net worth, you can kind of buy what you want at restaurants. Besides like the super expensive bottles of wine, you can basically get any entree you want. It doesn't really matter. And then level 4 is travel freedom, right? By the time you're at the end of level 4, you're near 10 million bucks. You can basically do everything except fly private. You need to think about risk a lot more when you're in level 4 than you were when you were in level 2 and level 3, let's say, because let's be honest, it's a 10 times larger impact, right? All else equal, right? If we're saying you start at 100,000, go to $1 million, right? It's a 10 times larger impact on the balance sheet. It's the most expensive thing some people own. That's relevant in a few different ways. And I think that's the way you play the game. And a lot of people don't do that, and they unfortunately learn the hard way.
You're watching Excess Returns. I'm Matt Zeigler, joined today by the one and only of dollars and data blogger, author of Just Keep Buying and now The Wealth Ladder, who, when he's not acting smarter and living wiser, you know it's because he's here with me, Nick Maggiulli. Welcome to Excess Returns.
Thanks for having me on, Matt. Appreciate it.
I'm excited to get into this. The new book's really awesome, and I know the people are here for zero DTE options and probably some meme stocks, maybe the occasional crypto ape or something like that. But you, sir, are the one who's got that old school can collecting experience.
Yes.
Can we talk about this for a second? What's can collecting mean to you?
So when I talk about it in the book, when I think about can collecting, I think when most people read that, they may have misconstrued it. Like that you've seen people go out and like grab cans and collect them and create these bags and then take them in for recycling. We didn't do that, but my dad, back in like the early mid 90s, like there was plastic bottles weren't as popular as they are today. So everything was cans, right? So like there was so many canned drinks everywhere. So as a little kid, I even like my dad had this thing where you put the can in there and it was a crusher, it would crush the can. So we would get bags and bags and bags of these cans. And in California, there's a CRV redemption value, California redemption value. You take them in, you get like 5 cents a can or whatever. And they would just weigh them and give you money. And so we would spend, I remember as a kid doing this like quite a bit, crushing the cans. I'd spend a few hours crushing cans, right, just to fill up these bags. When you crush them, you can get more space, and then you take them in, you get money, right? And so that was like, it happened over and over and over again, right? And so that was just something that I used to do, and now I obviously wouldn't do because it's not worth my time. It was just a simple example of how, as you build wealth, your opportunity cost changes. Like, it's not worth my time to do that anymore. And it used to be worth my time, right? Obviously, I was a little kid, so it's a different experience, but you get the point.
Okay, did you experience the profound disappointment of spending? So we had this machine in my basement too, in the early to mid 90s. And I distinctly remember getting to pass this job off on my brother because they were like, your brother's more hyperactive, so we're going to give him this job. And I remember him spending like a whole Saturday once crushing these cans and filling up the bags and then finding out what a disappointing amount of money it was worth.
Yeah, it was
when he went
like
to drop
$40.
with my dad.
Yeah, all day for $40. It's like what it was. It might even been less. I mean, it depends how many bags. I thought we used to get like, I feel like it was like 15 to 20 bucks a bag. I can't remember now, but these were, massive, garbage bags, right? That were full of cans. And so, yeah, it adds up, but it's still not too much, I know back then it's a little bit more money than it is now, but still it was funny. And it's funny, they don't adjust that for inflation, right? Like that value is still 5 cents a can, which means like it actually disincentivizes recycling, right? At some point, so.
It's a strange thing, but it's this awareness, and this is like the crux of the book, is this awareness of what are you trading for this other thing that you're accruing. So I'm curious because I'm going to jump way forward now. I mean, like analyzing Federal Reserve wealth data professionally here in this book. What's the through line between starting to figure out that this money gets converted into something, like my time is worth something, and then it turns into, why do you care about this writ large at the societal level? Why does this book exist?
This book exists because I believe a lot of people don't think enough about how their financial strategy should change over time, or at least possibly change. I'm not saying it has to, but there's a possibility of maybe I should do something different over time. I think we get caught in our habits and we do the same stuff for a long time and we don't notice it. And we don't ever question like, oh, does this make sense? It's like, imagine being in there and doing cans every Saturday for your whole life. And at some point you're like, why am I still doing this? Like maybe I should pay someone to do this because I can go do other things that are more valuable or more meaningful to me, et cetera. Right? And that's kind of the thinking. it's, we've all had points in our career where we had to do stuff that maybe we didn't love to do, but like we shouldn't be doing that stuff forever. We should find a way out of that. And especially as you build wealth, you should definitely find a way out of that. And so that's the high level version of it. I then took, the Survey of Consumer Finances data from the Federal Reserve. I broke it into these 6 wealth levels and then expanded from there. And I'm happy to discuss any part of that to make it a little bit easier.
Yeah, let's dive into that. I want to start with the raw data first. What got you looking at the raw data from the Federal Reserve data? What drew you to that data set? How'd you stumble into this?
So I've been looking at this data since 2017, and they do a snapshot every 3 years. So this is a different set of households every 3 years. So there's 2016 data, it's 2016, 2017, there's 2019 and 2020, and then there's 2022, 2023. So about 75% of the surveys are done in 2022, and about 25% of the surveys are 2023. So it's kind of like a mixed bag. It's not just all 2022, even though they say 2022. If you actually look at the footnotes, it's partially 23 as well. So anyways, long story short, I've been looking at this data for a long time. It's considered the gold standard of wealth data. And there's all these survey methods that I can't even fully explain. A PhD would have to explain it to you, but they basically weight all these households to adjust for like how rare a particular household might be. And you can use these weights to then back out descriptive statistics. You can't look at any one household and say anything, but you can say things about all wealth and all households. And of course, at the very top, it's a little noisy because there's not that many people that are that rich. So if they have too many of those, they could be oversampling or undersampling. So it's not perfect, but it's good enough to the point where I feel pretty confident in like how the distribution of wealth is changing over time. And then every time they go back and do this stuff, they adjust all the old data for inflation. So everything's being adjusted over time. So it makes it very easy to go through, check how wealth's changed over time. So every time you get the new data, all the old data gets updated, and then it really makes it super easy to, just compare wealth and how wealth has changed over time. And I think it's very important because there's a lot of, stories that are happening, under the surface, and maybe you might see them and see it anecdotally, but then within the data, you really start to see it. And I can expand on that later as well. Like some things that with the data, you're like, oh my gosh, this thing I saw happening, it doesn't make any sense. But then with the data as well, now it makes perfect sense what's going on.
Okay, very, very interesting. So you see this data, and we're talking net worth data here, right?
Yep. I mean, they have income,
right.
They have assets, they have liabilities. I just calculate the net worth based on those values. Yeah.
Why net worth? Why do you think that one matters the most to you?
It's the most important because, income's a flow, net worth is a stock, not like a stock like on the stock market, but like it's something that it's something you have saved up, and it's a little bit less fickle than income. Of course, recessions happen, market crashes happen, wealth can decline over time, but it's not like income where you just have your income and then all of a sudden you can lose your job and go to zero. It's not like the turkey problem, right? It's very unlikely that you're going to lose, 100% of your net worth out of, just because of a couple bad days in the market, right? So unless you're levered or have some weird asset allocation, right? So because of that, it's the thing I care about because it's the thing that is more portable, it's more stable, and it really it's true purchasing power that you can use to buy a house, to consume goods, whatever you want. And so if you have to pick between having $1 million in wealth or $1 million in income for at least 1 year, right? The wealth is better, right? Obviously for many years, that income can become a lot more than $1 million. So you'd probably pick the income, but in a short period of time, wealth is a little bit more useful than income.
I sure would like to spend $1 million a year for an extended period of time and report back on the experience. In the meantime, though, you'd take this data, and I agree with this because income, we really think about income as like you have a surplus or a deficit, and that accumulates into positive net worth. So assets minus liabilities, you get this number. Yep. And I do agree the balance sheet's where you want to focus. So I love that you're bringing it here. You take it a step further, though. You take the data, you chop it up into 6 different levels. How did you arrive at that number? Why did you decide to break it up the way you did?
So there's 2 things here. There's a question of accuracy and there's a question of usefulness. And so in terms of accuracy, these levels I came up with are obviously arbitrary. And I'll tell you the levels now. Level 1 is less than $10,000 in wealth. Level 2 is $10,000 to $100,000 in wealth. Level 3 is $100,000 to $1 million. Level 4 is $1 million to $10 million. Level 5 is $10 million to $100 million. Level 6 is $100 million plus, right? So it's a log-based scale, logarithmic. You're moving by 10x. Makes it very It's obviously not as accurate. Someone with $1.1 million is very different than someone that with $9.9 million, because 1.1 is obviously closer to level 3 and 9.9 is obviously closer to level 5, right? However, it's useful as a framework. You need to put the lines in the sand somewhere. And then within those lines, within those bounds, those levels, I don't say rungs because rung doesn't sound as, oh, I'm rung 1. It just sounds bad. So I say levels. I know it doesn't make sense for the latter, but just go with me. A lot of this is marketing. My first book wasn't called Dollar Cost Averaging because just keep buying sounds better. So you realize there's a lot of very deliberate choices made here. I'm not an idiot. I know what a rung is. It doesn't sound as good. So anyways, as I'm saying, you create these levels, then within these levels, it really just creates a mindset or a way of thinking about a problem within this kind of range of wealth. It's not perfect. It's just as you get into level 4, which is 1 to 10 million, what are the types of decisions you might make? Maybe for, someone who has like $8 million, maybe that's upper class already, and you're kind of have the level 5 lifestyle in a cheaper area. If you lived in like Alabama, you're probably living like someone in level 5, even with $8 million, right? So you get my point. There's a little bit of an art, it's a little bit fudgy, it's not perfect, but it's useful, right? Like every single time I've seen people say, here are the levels of wealth, everything's arbitrary, it's impossible to memorize, like there's no, the idea can't spread, it's gonna die like right out the gate. And so I've seen, the 8 levels of wealth, the 20 levels of wealth, I've seen all these different ones. They can't be memorized, right? So I'm like, I know this is arbitrary, but it's closer and it's more useful and it's more spreadable, which is more important for thinking about the decisions you need to make. I don't want you consulting this level thing 20 times to make a decision. I want you to have it once. Okay, level 3 is 100K to $1 million, memorize that. And then from that, you can go up or down by multiplying or divided by 10 and get on with your life, right? Like, it just makes it super easy. More importantly, the data fits it quite well. 20% of households are in level 1, roughly. 20% are in level 2. 40% are in level 3. That's $100,000 to $1 million in wealth. 18% of U.S. households are in level 4. That's 1 to 10 million. And then the top 2% is level 5 and 6. So it has a decent distribution across. It's not perfectly even, but it's like good enough. You can see, hey, middle class is about 100,000 to $1 million. That's middle class America, right? You can start seeing this stuff appear and you're like, okay, this actually makes sense. And it fits the data well enough that I think this is the way forward to help with these decisions.
So what I'm fascinated by this, and I share this fascination both with this data and with this specific point, and it's great that I also had the can crusher in my basement for this. Class mobility up the levels of wealth, not the rungs, the levels, or multi-level market scheme. That's another book title for you right there. Moving up and moving down. I want to start with moving down because you said something in the book that really kind of caught me off guard. People don't often drop. What's up with that?
It's very rare, and let me actually get the data. This is in chapter 10. So I have a whole chapter on mobility, and the whole reason, one of the reasons why I wanted to write this book, because I just wanted the mobility data. I wanted to know, like, what percentage of people that are in level 3 today end up in level 4 in 10 years?
This is the whole reason to read this book.
Yeah,
because of
just chapter 10. Yeah. So in chapter 10, over a 10-year period, and now this is regardless of wealth level. So across all wealth levels, roughly 11% of households will be down 1 wealth level after 10 years, and 2% will go down 2 wealth levels. This is regardless of where you start, right? Over a 20-year period, it's roughly the same. It's about 10% of households are down 1 level, 2% are down 2 levels. This is over a 20-year period. So most households actually stay in the same wealth level over time. In a 10-year period, 63% will still be in their same level. Over a 20-year period, it's about 51%, so it's still the majority. But now what does that mean about the other levels? There's also moving up, right? And so over a 10-year period, about 24% of households will be up either 1 or 2 levels. It's roughly 3% go 2 levels, 21% go 1 level, and then vice versa. Over a 20-year period, 32% will be up 1 level, 5% will move up 2 levels. So it just gives you an idea of, okay, well, if I'm in level 2 today, how likely is I'm going to be in level 4 in 20 years? Okay, according to this data, and that's not using the Survey of Consumer Finance, different data set, I can get into that later, but they follow households over time. Given that data, what percentage of people jump 2 levels, which is at least a 10x increase in net worth, if not more.
And I think this is part of what's really interesting here is because now that we're talking about mobility, we're talking about, well, what are the things you have to do to go from one level to the next? And talk about a lot of investment related stuff on this. We're going to dive into some of that soon in this conversation, but it's this idea of how do you advance your station in life? And from my can crushing days and apparently yours, that's a fascination. I don't want to be doing the same crap every single day if it's not fun to do. I'm sure some kid is can crushing, listening to this podcast right now going, I want a YouTube series that almost no one watches someday too. How do I aspire to that? Let's give them some inspiration. Somebody has $25,000 net worth. Start there. You're at level 1.
Oh, let's level 2. 25,000? Okay. Yeah.
Was 10,000 level 1?
10,000, yeah. It's all factored 10 base, log base 10.
All right, the kid crushing cans, sub 10,000, this part's not for you. This is for your older brother who's at the 25,000. Start me there on level 2. How does level 2 get to level 3?
So there's 2 types of people in level 2. There's people who just haven't had enough time to get out of level 2. They just need, maybe they have a good education, they're making decent income, they'll get future promotions, raises. They're on the path. They just started. Like imagine someone who just graduated college and they're doing the right things. They just need time, right? That's one of their issues. The other types of people in level 2 are people who don't have those skills, don't have any of that stuff, and time alone is not enough. Maybe with time they can get into level 3, but if they want to get to like level 4, they need to change their strategy, right? They can't just be like, I'm just going to do the same thing and just wait and let time do the trick. That's not going to solve their problem, right? So the thing I focus on in level 2 is education. So if you don't already have an education, and even once you have your college degree, it's not like you're done. Like it's not like the day I graduated back in 2012. It's like I've learned 0 things since then. No, I've had to learn a bunch of stuff. Like in my actual career, which I still have a day job, and in my writing stuff, like I had to learn how to write better. I had to learn how to write books and market books and like all these this esoteric knowledge that is 99% of people would find useless, but a very small percentage of people would find it incredibly useful. I have some of this knowledge, right? And so it's thinking through that, like what education do I need? What skills do I need to build so I can eventually raise my income, right? And it's a long-term process. I've been writing for basically 9 years now. And over that time, the first 3 years, I didn't make any money doing it, just did it because I loved it. But I kept focusing on every single week. I put out a blog post. I have not missed in 460 something weeks, I think, or 450 weeks, whatever it is. And so it's just been a long time and just been working on it. And so I think the thing I focus on is education. And that education is very broad. There's a lot of different ways. I'm not saying you need to get a college degree. I'm not saying you need to go to professional school. But the education means learning something that has value to others and that can make value in the marketplace. That's ultimately what we care about because that's how we create income and that's how we save money and build wealth.
And this is specifically in the labor marketplace or in the knowledge work marketplace. It's like learn something that you can go apply to work and therefore get income in exchange for this education. Is that what you're saying?
Yeah, I mean, it could also be, it doesn't have to be, it could be a blue collar job as well. I have nothing, It doesn't matter what type of role. It doesn't have to necessarily be knowledge work. I would say that is knowledge work. It's a different type of knowledge. It's a little bit more tactical, but yes,
Yeah, there's plenty of knowledge working HVAC owner operators and stuff who are crushing it. And that has to be commended too. So when you're converting this piece, how do you think about saving, investing, the whole 9, building that balance sheet to advance your station? So once you have the knowledge, how do you think about advancing it? What do you have to do?
So level 2 investments, I'm not trying to say this in a bad way. They almost don't matter. Just set something and just keep moving on your career because you don't have enough. Even if all 25,000 of that, let's say, was in a portfolio, your annual return is so small, it's not going to really make a difference. Even a 10% return, which is a good year, is $2,500. That doesn't do much for you. Don't get me wrong. It's not nothing, but you could easily overspend that. I'm like, what can you do to make $2,500 more? Like that's where it really starts to count. And as you get deep, of course, doesn't hold true forever. As you get deeper into level 2, once you start to get into level 3, then you got to really care about the stuff. And definitely, but you can just imagine this, starting level 2 doesn't matter as much. You got to think about your spending. You got to think about your income. And I just like that long-term growth in your income is going to be, that's the wedge, right? You have your income minus your expenses. And yes, your expenses can go up over time, but your income has to grow much more. And that's the key. Because once you want to make it easy to build wealth, right? You want to make it as easy as possible. And, cutting your spending to a bare minimum, and it's a really difficult life. It really is. It's so much easier just to have more coming in and be like, I don't even have to budget because I can go to the grocery store, get what I want. I can enjoy a night out of the restaurant. I don't have to panic and worry. It's like, obviously you're not going overboard with a lot of this stuff, but you can have a very nice, decent life, go out sometime with friends, do all that stuff and not have to worry because you have enough income coming in where the spending doesn't really impact it that much.
Well, let's jump right to it. The restaurant, what is it? Grocery freedom to restaurant freedom. This level 2 to 3 transition. What starts to happen there around that line getting crossed?
So yeah,
Tell
just
me
for the
what those
record,
words are. Yeah.
yeah, when I'm talking about this is in the book. The part one of the book, I do the intro, which is just explaining the wealth ladder, which we've already basically discussed. And then chapter one's about spending, chapter two is about income, chapter three is about investments. I'm basically setting the table. Here's the context of the wealth ladder. If you didn't read any other part of the book, this is like a basic understanding of it. You know, I still think there's a lot of value in going deep into each level, which is in part two. But for now, this is the high context. And what you just referenced was in chapter one, just on the spending context. And so what I say is, as you get to different wealth levels, you unlock different amounts of spending freedom. So as you get into level two, and by the end of level two, you've unlocked what I call grocery freedom. You can go and buy what you want at the grocery store. It's not going to really impact you. In level three, by the end of level three, by the time you have almost $1 million net worth, you can kind of buy what you want at restaurants. Besides like the super expensive bottles of wine, you can basically get any entree you want. It doesn't really matter. And then level four is travel freedom, right? By the time you're at the end of level four, you're near 10 million bucks. You can basically do everything except fly private. That's fly private. It's technically the only piece of travel freedom that I would reserve for level five, but like you can go stay at a very nice hotel. You can upgrade to first class if you got 10 million bucks. It's not a problem. And the logic for this, I explain it in the book. I'll try and briefly explain it here. It comes from something called the 0.01% rule. And the idea is your wealth is generating 0.01% per day, which on an annualized basis is 3.7%. So it's kind of like the 4% rule in disguise. It's even more conservative. And the idea isn't that you spend this wealth every day. It's not like, oh, you take that 0.01% and you spend it every day.
Speak for yourself,
On occasion, you can spend that 0.01% and not worry about it, right? If you're doing that a few times a week, not a big deal, right? And so if you have a net worth of, let's say, $1 million, that means your wealth on average is generating about $100 a day. So if you're like, hey, next time I go to a restaurant, if I want to order the steak and it costs $50 more, who cares? I can spend, I know $50 is not a big deal, right? Like, cause my wealth's generating $100 a day, so I can cover up to 100. I can get the steak and maybe 2 glasses of wine. I mean, I'm saying this from New York prices, $25 for a glass of wine is kind of crazy, but assume tax, tip, and everything, right? You can spend that $100, no big deal. You don't go, it's not every day. You just do it every once in a while and just relax. And the idea is, I'm trying to solve the lifestyle creep problem, because the problem is, most personal finance people don't let your lifestyle creep. Don't. And then what it does is create stress, and now you're second guessing yourself. Like, you're working so hard and you're not even enjoying your money. It makes no sense. I was like, okay, I think I'm trying to solve this problem by saying you can spend more money over time, but only after you've built wealth. And that's what the levels do. So you have to be in level 3 to start, really, going all out at a restaurant. You have to be in level 4 to start upgrading your seat on an airplane, right? You get the point. So and this really just fits really well with the spending categories and the wealth ranges and everything. And I think it's just a useful framework for people to use here.
I think it's an incredibly useful framework, because it breaks it down in both directions, both what the impact is on the balance sheet and also what the impact is on the cash flow statement, and understanding how that works in your financial life. So this transition from 2 to 3, you talked about at the beginning of 2, where education is the focus. How does that start to shift as you get into the higher levels of 3?
So in 3, the shift really does move toward investments at that point, and every chapter has like a catch line of like, hey, here's the catch line strategy. This is the main strategy. And so level 3 is where I say just keep buying is the strategy. And Just Keep Buying was the name of my first book, right? And the premise of Just Keep Buying is the continual purchase of a diverse set of income producing assets. So I wrote that book as like a one-size-fits-all answer for personal finance and investing. And I think it's a great solution for most of the people. I mean, once again, 40% of the country is in level 3, 20% is in level 2. So for the vast majority of the country, 60%, this book or this idea is the strategy people should be following to get into level 4, right? But you're not going to get into level 5 with that unless you have a really, really high income, right? You're not going to get to 10 million plus, and I can talk about that later. But the focus is moving toward investing, because that's where you can really start the compounding does help. You're adding money. And so your portfolio is like starting to compete with you a little bit in terms of how much wealth it generates for you. And then by level 4, it definitely is competing, and maybe even out competing you, depending how deep you get into level 4 and your income.
So then how do you start to think about the focus on the investments? Because it's not like I hit level 4 and now I'm a hedge fund manager.
Yeah.
What do you think the mindset shifts are? Because these are progressions. This is a very different mindset. If somebody has that upward mobility, they're making these decisions, they're saving this money, and now all of a sudden they go, hey, wait, my portfolio is generating as much money or better returns than my job.
Yeah. And so I think the thinking here, you're right, it's not to become a hedge fund manager. No, you need to be day trading. No, that's not the focus here. The focus is just you need to think a bit more about diversification. You need to think a bit more about taxes. You need to think about risk a lot more when you're in level 4 than you were when you were in level 2 and level 3, let's say, because let's be honest, it's a 10 times larger impact, right? All else equal, right? If we're saying you start at 100,000, go to a million, right? It's a 10 times larger impact on the balance sheet. So that's what I think about in terms of this stuff. And yeah, I'm not saying that there's a right way to invest. I think there are wrong ways to do it, but there's a lot of wrong ways we can identify. I also think there's a decent number of decent ways to do it, but it all can be summarized in a very vague statement, which is the continual purchase of a diverse set of income producing assets, right? And I'm purposefully not saying, well, which type of assets? Well, there's a lot. People get rich in real estate. People get rich in stocks. People get rich while owning bonds too. Like, people get rich in a lot of different ways, or I mean, rich enough. And when I say rich, I mean like level 4 wealth. That's even this. The words are very vague. So if I say, you could get to level 4 following just keep buying, that's what I meant. I didn't mean you can get to 100 million plus by buying the S&P 500. Like, no, that's just not going to happen unless you're making 10 million bucks a year. Then maybe you could.
Yeah, it's interesting how much of it falls back on that net savings rate, right?
Yeah, of course. I mean, but people that are making $10 million a year aren't buying VOO only and just waiting. Like I would be shocked if there's anyone even out, even if there's more than you can count on one hand how many people are doing something like that. I think very few are. They would be buying privates or something else, or they probably have their own business which is generating that income. So they're actually very concentrated. If I'm being honest, very few people make that level of money and have a standard job.
Right. This is the part where you have your own insurance company. So you get the float to manage the leverage, right? That's how everybody does it.
Yeah.
All right. Well, on that's a little tongue in cheek, but also a little bit serious. Level 4 and the upper levels are where we start to see concentrated positions. We start to see direct business ownership, things like that. How important is that level of commitment to a single idea to upward mobility from here?
I think it's incredibly important in level 5 and level 6. I mean, to get in there. I mean, once you're in there, though, that's a different story.
Right.
And if you want to stay in there, that's why there is truth to a lot of these statements. Concentrate to get rich, diversify to stay rich. If by rich you mean level 5 plus, I agree with that. If by rich you mean level 4 plus, I'd say, no, you can diversify and get rich. Like you can get into level 4 is what I mean. Because I've never had a single position that was larger than 20. I guess even my largest position is like 20% of my portfolio, but that's like a private business ownership, right? Because I have equity in a partnership, right? But excluding that, like in terms of my actual portfolio, I've never had a single position that was over like 10% of my portfolio, if that. And all those positions were diversified like index funds. So it's not in any given company. It's never been. It's whatever like the largest company in the S&P is, like 3% maybe of my net worth was in maybe the largest company, and maybe if that. So, and when you add bonds and all the other stuff I own, it really dilutes that number. So when I think about it, yeah, I think you do need to concentrate to get into level 5 or 6. It's just because it's really hard to create wealth like that without some sort of owning an equity or something where you have the control and the ability to earn that level of income.
So for a person who's in level 4 or a family who's in level 4, part of this conversation becomes, if we want to keep increasing this, if we want to take another station step upward, you got to look for some of these opportunities. How do you think about the behavioral aspects of figuring out what are the opportunities I should even put in front of myself or put in front of my family or just entertain if you want to keep growing wealth?
Yeah, I guess it depends. I mean, people can do it with investing. I'm not going to say it's impossible, but you're going to have to make a concentrated bet. And once again, that's difficult. It's very tough to know what's going to beat the market. And I knew NVIDIA was going to do this. Maybe you did, but a lot of people didn't. I mean, I think it surprised everyone how much this company has grown. And that's one example, but it's obviously the example that everyone's talking about now because they say, something like half of the NVIDIA employees have like 10 million plus in net worth now, or just because of NVIDIA stock, which is crazy. It's like, how do you even motivate these people to work? Are like, I want to get to 100 million. Like what? Like, I guess you got to care about the mission. So that's probably the most why they're doing it and not necessarily for the money, but they are very concentrated. So that's the issue with this, right? So for the most part, the people when they're thinking about, do I want to get to level 5? It's like, that is the big decision you have to make in level 4. Is like, can I just chill out? I can take my foot off the gas and do something like Coast Fire, which is a much more relaxed, like, hey, I have enough to get to retirement and I have enough money now. I don't need to be working this high stress job. I can work a much lower stress job, or I can be a consultant or something and make much less money, but have much more happiness and enjoy my life more.
So this is not there's no gotcha inside of this. I'm just curious. The first person who I saw writing about this stuff and the comparison between relative net worth levels and ascension was Ashvin Chabra. Do you know that name at all? Did you ever come across The Aspirational Investor, I think was the book?
I don't think I've read it.
Okay. So this is, again, not a gotcha at all. But one of the things he points out in his framework, and this really opened my eyes up 10 or 15 years ago to this stuff, was you solve for like your safe assets, you solve for your market assets, and then you make this choice around what you define as level 4 into 5, where it becomes these aspirational assets, where it's like, if this works out, it might work out insanely well. It could also just work out at market level of returns. And it could also not knock me down a full level if this doesn't work out.
Yeah. There's different ways you can allocate that. Yeah.
Yeah. How do you think about that? Just because this is a really interesting structural problem for that 1 to 10 million north range.
I mean, there's a lot of ways you can structure. I mean, it doesn't cost that much money to start a business, right? It depends on the type of business, obviously, but like you could take 50 grand and go start a business and try and, bootstrap it, so to speak. You don't need to necessarily raise funding, and just try your best to see where you can get with that, and like, oh, you lose 50 grand. If you're deep in level 4, like that's not going to, you probably won't even notice it, right? If you have like $3 million, like, okay, 50 grand's not the end of the world, right? So the question though is like, yeah, do you want to go and take those types of bets? Why are you taking those bets? Like there's a lot of questions about that and the amount of work you have to put in, right? I think it's a bigger, I think I haven't read this book, but based on what I just heard, it sounds like he means just like an allocation. Like he's like, oh, I'm just going to put this 50 grand in this aspirational asset. Like I'm going to buy GameStop and hope it goes. Maybe not GameStop's not the best. Yeah, but
he's not
something
saying
like that.
But it's
but like, yeah, okay, put it in a value of a deep value stock you really believe in, right? It's like you are making some sort of active bets in investments. I don't think I don't understand it completely. It sounds like he's doing active bets and not like, oh, you should go start a business with the aspirational assets, right? Is that it's more of a,
in this case, he's saying once you've achieved that safe level of wealth, you're just keep buying market level.
Yep.
Then it's like you can start the business, you can expand into the
Okay.
investment property or real estate. You can go buy the hedge fund or take the deep value bet. But realizing that you've bucketed it separately because psychologically, it's not going to knock you down those pegs.
Yeah,
Hence
no,
the
I agree with that.
leveling.
I agree with that completely. And I think that's also, as you kind of move in from level 3 to level 4, there are arguments to be made about actually taking less risk. Even though you have the capacity to take more risk technically, right? Because you have more money, right? You'd be like, hey, even if I lose $1 million, who cares? But you're not. My argument is you should lock up some of that in case like something bad happens. Like you really can permanently keep yourself in level 4. And I think if you think, oh well, I have more money, so I can take much more risk than someone who's poorer. Technically, that's true, but that's also a way to like not be in that level anymore, right? I think that's the people that need it that need the most growth are the ones that technically are lower on the ladder, need to take more risk to get up the ladder, right? Because if something bad happens, they can offset with their income. If something bad happens to you in deep in level 4, your income's not going to be able to help you get back up as easily. So that's really the thinking. That's why when I think about actually like, you kind of need to take risk off the table as you build more wealth, right? Which is kind of counterintuitive, but I actually think it's true, even though the risk-taking capacity has technically increased.
Yeah, which also is a really interesting way to bring it back to the net worth part of the equation, right? Like if you're solving the reduced risk on a net worth basis, that doesn't close the door to what you're doing with your income. It doesn't close the door with what you're doing for the rest of your planning.
Completely. I agree.
Let's go to just sort of where we are this space and time, because there's other just weird stuff that happens over different periods. Like right now, a money market's going to pay you 4.5%, somewhere in that range. That means very different things for somebody in like, say, level 2 versus level 5. How do you think about stuff like interest rates and the impact on how different people make different decisions at different levels?
Yeah. So you're far more likely to, that's why it's, once again, we're kind of just talking about this, but like you're far more likely to own and enjoy fixed income in level 5 than you would in level 2. Because don't get me wrong, yeah, the person level 2 doesn't have a lot of money, so they're thinking, so you're like, well, they got to protect what they have, but like they have so little that they're more likely to make a bigger impact with their income or something else than by protecting. Like, they need growth. Like, someone in level 2 should be like, it obviously depends your age, depends on a lot of other factors. You can't just do this in a vacuum, but like all else equal, same age, same everything. Like, you would want the person level 2 to have a slightly more aggressive, portfolio than the person in level 4, because the person level 4 probably needs to protect that wealth. Person level 2 needs to grow it to really, reach a more financial freedom.
What about the impact of taxes? How do you think about that as it scales? Are there different lines in the levels where you go, hey, you really got to pay attention more to taxes and what's going to take a bite out of this?
It's correlated completely with the investments, right? So it's like, as your investments get bigger, the investment decisions become more important with each level. I mean, on average, it goes up 10x, right? So the same thing's true with the tax thing. Like, tax teams, once you're in, 10 million plus, they pay for themselves. There's absolutely, unless you're already doing everything perfectly, it's very likely, and we see this all the time, and I'm not just trying to rep our business and stuff, but we hear, oh, we saved this client $100,000. Like, they're not paying us anything like $100,000. And this doesn't happen with every client. This is not a guarantee, we can save. That's not what I'm saying. So for the record, this is not normal. This does happen though. Someone has a prior accountant. The prior accountant maybe wasn't as good or missed something. They come over, we look at their thing, and we find these savings sometimes. It doesn't always happen. So once again, disclaimer number 2, like, this is not a guarantee, but this type of thing can happen. So I think tax advice in general, I'm not even just speaking about my particular firm or anything, is very useful the higher you are up the ladder. That's it. Like, it's just true, because if you're making a mistake, the mistake is much larger than if you're making it on a smaller balance. Like, that's it. It's like, that's why these teams exist. That's why there's multifamily offices. That's why, because like, the more scrutiny and detail you can look with these things, the better of a decision you can make. And so you have to pay a small fraction of what you're going to be earning off of this, right? At least in theory, assuming you have a good team and everything, not someone who's scamming you and skimming money off the top and all that stuff. So assuming, someone who's a fiduciary, et cetera, that's the goal.
We had a situation not long ago with a client where we were asking, it was a new client. We were talking about taxes, and we said to him, are you happy with your accountant? Is there anything you think we need to check in on here? We're going to look at the tax returns and stuff. He was like, well, actually, I'm going to send you the return. I'm going to send you an article. I think I might need one. It was like the largest accounting scam in like the state of New Jersey in the last.
Oh, wow.
He's like, I need to get all my stuff away and have it all now checked for several years. And it's, these things really happen in the real world.
Yeah.
But the other part too is taxes are always part of that link between the cash flow and the balance sheet.
Yep.
So it's like net savings is dependent on not needlessly giving money to Uncle Sam or taxes or whatever else.
Exactly. And so there's obviously tax games you can play, and there's, especially with business ownership, and I would say somewhat smaller businesses, especially as you get too large, like kind of a lot of those, not all of them, but some of the benefits go away. But there are like a lot of little things that they have out there that are used to help people in those circumstances where you can be, your revenue's not as high as maybe your job was, but because of deductions and things, your take home might be higher, which is interesting.
Yeah, often overlooked as people try to climb these ladders and these steps up too. Jump back to level 3 for just a second.
Mm-hmm.
How would, somebody around our age, somebody younger who's saving money, how should they think about asset allocation? How should they just think about what they own at level 3 into level 4, or the younger people when they hit level 4? What do you think the mix looks like?
This is a really difficult question.
Why is it difficult?
Once again, it's difficult
on
because
purpose.
everyone, and it's not just, it's hard to provide. It's like with tax advice. Imagine you said, okay, what's the best tax thing they could do? Let's just take it to tax. I'll come back and
Nick,
answer your
what's
question.
the best tax thing I can do right now?
Well, you is different because I might know something about you. I might know something about your living situation. I know what state you might be in, et cetera. But when you say, what's the best thing someone can do for their taxes? Like, do you mean federally? Do you mean like their state, local? Like, there's so many different taxes and things, and everyone is in so many different situations. That's why how many popular tax books do you know of? I know of literally zero. I mean, I know some good tax books out there, but they're not that popular because it's really, really hard to write about specific situations and make generalizations. It's very difficult, right? That's why like the wealth ladder is trying to make the best generalizations they can, controlling for each level of wealth. And so I'm doing my best, right? But at the end of the day, even within these levels, age changes, location changes, your occupation, all these different things will impact the advice. So you got to try and give the best advice you can. But with tax, it's even more insane than that in terms of the amount of customization that can happen, right? So it's really hard to write about tax advice. And I think similarly, it's really hard to write about asset allocation advice because, oh, do you have a family? Do you not have a family? That changes your risk-taking behavior, right? Like age, obviously you said about our age. So you probably could be taking a little bit more risk, especially level 3. You're probably taking a little bit more risk. But, how do you view assets? Like some people love real estate. It's tangible. It's something they can go visit. I can go, unlock the door. I see it. Like that is real to someone in a way that a VOO in a number in a bank account, like, digits on a screen isn't. So some people aren't going to feel comfortable with that. When they see those digits go down, they're going to panic. They don't see that happen on their rental property, right? So I can't say, oh, here's what everyone should be doing because it's not true. Some people are not going to like the idea of owning stocks, which I'm very comfortable with, owning index funds, passive index funds. Some people are not going to be very comfortable with wanting to deal with rental properties and renters and all that, but these people can both build wealth, right? And so that's the truth. And that's why I don't ever give, oh, here's an allocation. I can tell you about my allocation, and I'm like basically all financial assets. And it's, my equity is half US, half non-US. I have a little bit of fixed income right now because I'm trying to buy a house. So I'm rolling treasuries, which I normally wouldn't have. So I have like 20% of my allocations in treasuries, which I normally would not have. But because I have what's the point of money? We need to spend it, right? Like, why am I doing all this, right? Like, so, I'm doing this for a reason. So I have money in treasuries. I have a little bit in some tax-free munis as well. So I'm getting a little bit of income from that. But like, for the most part, I'm like risk on equities, REITs, like, that's basically it. And I have some 5% of my portfolio is in a mix of non-income producing assets, which is, Bitcoin, gold, and art as of right now. So it's a very small percentage of my portfolio, just as kind of a hedge and like but I'm not a big non-income producing asset person.
I asked you this deliberately because of how thorny and nuanced this is.
Mm-hmm.
And it's a red flag when somebody wants to give you direct answers on this thing. I'm trying to say this all the time.
Yeah, I guess it depends the context, but I would say generally
Context.
yes. There's not always a red flag. Somebody like, here's why I think this is a great portfolio. Yeah.
Yes to all these things. All right, let's dive into a couple other parts that I wanted to get to. You said that ego is the most expensive thing people own. What's up with that?
Ego is the most expensive thing some people own. That's relevant in a few different ways. I think if you think about the level 5 business owner that thinks they're basically on their way to level 6 and why would I diversify? I'm basically on my way there. What's the punchline? The ego is the most expensive thing some people own, right? Yeah, it's interesting because actually, no, the actual quote from the book is the most expensive thing some people own is their ego. So like the wording of it is actually flipped a little bit. But the point is, some people, their egos are preventing them from doing things that are going to help them stay wealthy in the long run, right? I think that's true at the higher end, level 5 and 6. It's where this is probably most true because people say, oh, this will never happen to me. This will never. And to get to level 5, you got to have some talent. Obviously, there can be a little bit of luck involved, but like, it's not easy to get there. So I get the ego. I get like, you did something very rare. You did a great job. And then you have this guy who's never done it, me, trying to tell you that you should diversify a little bit. And it sounds a little crazy. Like, why would I listen to him? If I listened to him, I never would have got here, which is true. You never would have got there listening to me. At the same time, but you're there now. You kind of hit this lottery ticket. Maybe you got to take a little bit of chips off the table. I'm not saying to sell everything. Once again, this is not an all or nothing type thing, but like maybe I have a friend who bootstrapped his company and he didn't need to raise money, but he sold some because he's like, hey, just God forbid this thing goes to zero. I have a few $1,000,000 in the bank. He's now permanently in level 4, barring a nuclear, Armageddon of the earth. He's going to be level 4 the rest of his life for sure. And it's actually in level 5, but even if his business disappeared tomorrow, he would still be okay. And I think that's the way you play the game. And a lot of people don't do that, and they unfortunately learn the hard way.
Now, what about on the way? How do you see ego as playing the role on the way up? So like you're just starting out, you're at level 1 or 2. How important is that ego a sense of identity and self that helps propel you further?
I mean, ego is not bad all the time. And I think there's times where it's good, but for that particular, line, the most expensive thing some people own is their ego, is relevant for those that have already made it or for those that are maybe spending more than they should be spending to kind of give off a certain appearance. I think that happens. There's a little bit of that in the data where we looked at households that were started in level 3, and we said 10 years from now, what percentage of them, made it to level 4 versus stayed in level 3. And we looked at the differences. One difference we found, those that made it to level 4 from level 3 tended to have a higher income. So that was a big piece of it, right? They earned more money so they could save more and move up the wealth ladder. Makes sense, obvious. But one thing which is not as obvious, the people that stayed in level 3, they spent almost as much money as the people that made it to level 4. So even though they're not earning as much as the people that end up making it to level 4, they're spending almost as much money as them. So there's a little bit of, keeping up with the Joneses happening in the data. And it's not too extreme, but like, it's like, hey, you're making a considerable amount less than these other people, but you're spending almost as much. And I think that, and where does that show up? That mostly shows up in housing. Like the biggest asset for those in level 3 is going to be their primary residence in the United States. So that's where I think it shows up. They got a house that was too big, or they wanted to, show off, have a nice house, whatever. I get it. But that's where I think people overpay for things. And it comes back to maybe get them in the end, because it makes it harder to get out of level 3.
Are there some other surprises like that inside of the data that you found?
Another thing I found, I guess I guess it was surprising, but I also kind of maybe knew it was possible, but I didn't realize how bad it was. So in level 4, I looked at this. So once again, you imagine a mobility matrix. You start in level 1. What's the percentage of people that get out of level 1 or are still in level 1, right? You can just imagine, a matrix of all the starting levels on the, on the rows, and then all the ending levels along the columns along the top, right? So you can imagine that the diagonal is like the percentage of people that stay in their level. Over a 20-year period, level 4 is the level that's the hardest to get out of. Of the people that are in level 4 today, most of them, I think it's like 64%, will still be in level 4 20 years from now. I'm using historical data, so obviously the economy, things could change, but averaging across all the periods from 1984 to 2021, you look at all those 20-year periods in there, it was 64%. So basically, it's the no man's land of wealth. Like once you get in there, you can't get out. That's not a bad thing. I'm not saying you need to get out, but I'm just saying that's why I talk about this business ownership thing, because getting out of level 4 is incredibly difficult, and there's nothing wrong with staying in level 4. But if you do want to get out, just realize the odds are very much against you, in the upward direction.
How do you think about it for you? So on just a personal level, not asking you to disclose personal financials, but how do you think about, is there a sense of enough inside of here of what you're aiming for? Or is there a evil game the system? I don't see this at all in you, but
game the system. No,
like, now that I've studied this data, Nick Maggiulli is going to.
There's no way to game it. Trust me. If I was trying to game the system, I wouldn't be selling books. Books are one of the lowest margin things. I would be selling high price coaching or courses if I was just trying to maximize every dollar, but I'm definitely not, and I don't see, if I had to, if I lost my job or, had to do something, maybe I would, but for the time being, I'm happy just doing books. So, in terms of my thinking on it, like I've already run the numbers on this. I have enough money where if I just had to worry about myself, I would never need to work again. Just my personal consumption and how much I consume. I'm not saying I'm a cheap spender. I would never need to work the rest of my life. I'm working because I might have children. I might have to take care of my parents. I have all these unknown liabilities. My sister, she's doing okay, but like she might need help medically. Who knows, right? I'm not working for myself anymore. All the work I do at this point, given my asset level, is for any other liabilities that are coming up, right? So in terms of how I think about it, the only thing I'm thinking about, and I say this in the book, I'm in level 4, but I'm not thinking I don't need to get to level 5 to service all those liabilities, but I do need to stay in level 4, and I do need to build a little bit more wealth to be like, hey, I can take care of these other things. And of course, the future's uncertain. You never know. I could get struck with a crazy disease that costs a lot of money, then maybe I wouldn't be okay, right? So I'm saying that assuming what I know now today is true going forward. Obviously, the future changes. Things are uncertain, but it's just thinking through, like, when I'm thinking about this problem, I think of it as very much like, I could see myself in like 10 to 15 years being like, okay, time to coast fire. I don't need to be working forever. I can take a step back and do something else and maybe just, do something. I have no clue, but that's my thinking on the issue, only because I could see myself taking a break and taking a step back, because I don't necessarily need to work a job and have the books and have the blog and all this stuff. And maybe I take the step back from blogging and say, hey, I've written for 9-10 years. I'm done, guys. I put the books out there. Maybe I'll write, once a quarter or something instead of every single week. I haven't decided yet, but we will see how that evolves.
I look forward to you dialing back the writing and focusing on Twilight fan fiction or whatever comes next. 50 Grays Shades of Maggiulli.
50 Grays of Shades, yeah.
50 Grays of Shades. I want to call this out because you said it there, and I think this is one of the interesting things of you talking about where you are and how you think about this. saving more for future liabilities that are unknown. I think a lot of us get caught up in the daydreaming of the assets and the future net worth as like, that's the part we focus on, the future things we're going to have. You're specifically calling out the future things that you're going to have to spend money on that you
Yeah.
don't know what they are yet.
Yeah. And I don't talk about that in the book at all, but that's just something like when I'm thinking about the future, like, because I don't know, like, well, how much am I going to have to support my parents, like, when they're in retirement? I don't know. I think it's probably, my dad's probably fine. I think I'm going to have to support my mom, right? How much am I going to have to support my sister, possibly? I don't know if she gets sick or something, God forbid, were to happen, right? I think about all those liabilities, right? And that's the stuff. Because right now, I think I'm relatively lean. I'm not spending too much on that type of stuff, right? Once in a while, they might need help with, what, my tire blew out. I need this, my radiator fixed, whatever. It's like, $500, whatever. It's not a big expense, but some point these expenses are going to get larger, and I had to be ready for that. Like, and then kids, like, how are we going to, educational costs? I have no idea what those are going to be. How is that going to be in a world of AI? Like, what is, like, I don't know the future, and there's so much uncertainty that it's really hard to plan for it perfectly. But, I feel like I personally have enough for me, but I can't just think about myself. I have to think about all these other people that I might have to take care of. And that's how I view this type of stuff. And so that's really it. Because I've done the math on this. Like, I'm very conservatively, like, I could literally just say, hey, not work anymore. I have books out. I have stuff. Like, I could just blog once a week and I could live the rest of my life and be fine. But in terms of if I need to also deal with all these other things, that's not necessarily true.
So I'm not pitching the future liabilities book, but I think just hearing you say that and thinking it's underneath a bunch of the stuff when you talk about yourself in the book. And I'm really happy that you actually dove all the way into that, because it's, and actually a question specifically about this with mobility as we cross generations. So parents have the wealth. What happens to the kids? What happens to the shirt sleeves stuff? What do you think of those topics?
I think it makes sense. Who's a really great writer on this is Fraser Rice. He wrote Wealth Actually. And so his whole book, which is like, decision making for the 1% is what he called it, he talks about all that stuff because the growth rate of the family exceeds the growth rate of your wealth in a steady state, right? So assuming you're doubling every 25 years, actually, I haven't done this math. Let me do this. So if 2x, 2 to the, what time? I'll have to do this after, but that's going to grow at some rate, right? So if you're doubling every 25 years, you're growing at, what's a rule of 70? So it's like basically 3.5%, 3% maybe?
Something like that, yeah.
Yeah.
I'd say that's
so 2.5% maybe is like what let's say 3%, right? Every 25 years, your wealth can't grow like that indefinitely, right? You hope it could, right? But it may not necessarily grow like that. And it's not even actually doubling, it's more than doubling because, let's say you have 2 kids. Well, they're going to have 2 spouses. And then let's say each of them have 2 kids and then those kids have 2 spouses. So it's actually doubling. You and your wife have now, just from the next generation, are going to have 4 people, right? So 2 people became 4 people, and then 4 people becomes, 8 people, and it just goes up from there very quickly. And so that's why, the Vanderbilts, like, what happened to their wealth? Well, it got divided by like hundreds of people. Like, that's what happened. There wasn't any millionaires, but there's a lot of people that had some money. And so it's not bad. You can still do very well, but like, it's not the same as like, it just goes down one lineage forever. It has to get divided at some point.
I'll never forget the very real example of this was working with a family where we're going through the balance sheet. We're figuring it out. Lots of money, lots of family wealth, and then very successful. And they were like the great grandkids. And they were like, it's like, what's this thing that you're paying these taxes on? What's this weird piece of property? It's like, oh, we own 1/16 of this like lake house from 100 years ago. And it was just every time it got passed down in the family trust, it got divided again. And there were 16 co-owners of one piece of property. And granted, it was an important family heirloom, if you will.
Yeah.
But this is the reality. The pie keeps getting divided faster than the value increases in most cases.
Yeah. So no, those people. And so obviously, I think more if you can instill the right values and, hopefully the market economy works for them and they, you can keep building wealth as a family, but it's tough because you're going to have certain people that just, they don't want to work or they don't care or they don't, have the right skills or whatever motivation that happens in there. You're going to have all sorts of different liability profiles. Some people want to spend a lot and they spend down some of the assets. So it's very interesting because over time, like this stuff does kind of, they say shirt sleeves to shirt sleeves in 3 generations. And I can very easily see why that happens, right? And also the wealth you had, the whatever income business, that thing's not going to survive forever, right? In 3 generations, that's 75 years. Like, what was the biggest companies, 75 years ago? Think about how big are those companies today? It's like the GEs of the world and stuff. Like GE got destroyed, kind of recently, right? So it's like they can be big for a long time, but like they get eaten up, creative destruction.
And we could make a NM shirt with a GM shirt. We could get this branded. I see where this goes. So I want to ask you just a couple of standard closing questions here. The first one, if you could teach the average investor one thing, is there something you would want to teach the average person? I'm assuming this is just going to be a plug for Just Keep Buying.
No,
if there's some addition.
No, I think the thing, just to make sure, because I've seen this surprisingly, understanding like how taxes work in accounts, like in a 401k account. For example, traditional versus Roth. Though if we assume the same average tax rate, that is a big assumption, those are equivalent. It does not matter, if you take the tax, don't pay taxes now and pay them later when you pull it out, or you pay the taxes now and don't pay taxes later. They are the same thing. And I've seen so many polls on Twitter where I say this to somebody. I say, hey, which one's larger? And literally so many people will say, oh no, traditional is always better, always better. And maybe it is because of average tax rates have kind of come down, but if even average tax rates go back to what they were in the early 90s, where the lower end is much higher than it used to be, you will see a reversal in this. So it's been true that traditional has been better, but we don't know future tax rates. And until we do, we're not going to be able to say whether Roth or traditional is better at a given point in time. And so I think just understanding that, it just upsets me when I see so many people say, oh, traditional is always better. Here's why. I'm like, you're saying that now because rates on the lower end went down. So the average effective tax rate when you pull out will be lower. I agree now, but people back then may have been contributing at a much higher rate. So you're not thinking through that. You don't know the future taxes. You're saying that kind of with hindsight bias, which is not really correct. So that's my one takeaway. I would not plug my book at all. So
congratulations, but you did plug. I think I'm responsible personally for at least like, I'm not asking for a royalty, but at least like 30% of the website traffic to that blog post. From how many years ago did you write this?
I don't know. I've been writing about this for a while.
Yeah.
So.
There was a big one that I have sent to more clients than I care to admit right now, but what a wonderful way to break down that data. All right, one more question for you. Something that you believe that you think the majority of your peers would disagree with.
This is a good one. And so I think they might agree with me. They might say, oh, yeah, I agree with that. But I think deep down, they actually disagree. Now, I'll give you the example. So in the wealth ladder, when I talk about levels 5 and 6, I talk about the downsides of wealth and like some of the bad things that can happen in terms of how they can damage relationships, how they, can mess with, your feelings about, do you owe society things? There's all these different types of issues that I talk about in levels 5 and 6 in particular. Right. And when I tell people, I fundamentally believe that more wealth at a certain point can ruin your life. Like, I think if I had a little bit more wealth, I think I'd be fine. But if you 10x my wealth from here, I honestly think my life could be materially worse. I mean, not like material, like, oh, I can't buy more stuff. I mean, just the way people would interact with me would be materially worse. Like, I'm not rich enough now where if I meet someone, I feel like they're using me for money, right? Because they don't care and then we're chill as friends. But if I 10x my wealth, like I might reasonably be a little worried that someone's just using me. Now I am paranoid all the time and I can't even go into interactions without imagine being a celebrity. Like, it would just be a nightmare to meet anybody because you don't know who's legitimate, who's not. It's like, you can't live a normal life. You can't walk down the street. You can't do it. And maybe that's just fame, but with money, if someone knows you have money, that's where it's really a problem. And so I fundamentally believe that more wealth does not always bring good things. And I think a lot of times it actually can make your life materially worse.
Can't remember who the quote is attributed to, but it's like the optimal level of wealth is where you can get the best table at the restaurant and not have anyone recognize you.
Oh, that's awesome. Yeah, that's great.
That's the narrow landing strip you want to hit.
Yeah.
Nick, plug the book one more time. People want to follow along online, bug you on the internet. Where should they look you up?
Yeah, so it's the Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. You can find me on X or Twitter at Dollars and Data. You can find me on LinkedIn at Nick Maggiulli or Instagram at Nick Maggiulli. And my website's of dollarsandData.com. And I do respond to every DM. So send me a DM. Trust me, I've been getting a lot of DMs these last few weeks. Also, I have to plug it. I just hit the New York Times bestseller list this week. So I have to plug the book. Thank you for that New York Times. But yeah, so that's a lot of good stuff's been happening. So I've been very busy with DMs, but I will respond to all of them, I promise. So thank you.
Excess Returns, clearly the New York Times bestseller list of financial podcasts. Nick, thanks so much for joining me today.
Thanks again, Matt. Appreciate it.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.